Right, let's move and keep the theme back, take the theme back to India and look at the investment opportunities there. Our next guest is increasing his allocation to manufacturing and export beneficiaries. Satish Ramanathan is CIO of Equity and JM Financial Asset Management. Satish, thank you for joining us. Why?
Good morning, and thanks for having me on board.
So, give us a sense why you're going overweight on those two particular industry groups that I just mentioned. And, you know, we are looking in effect here at defensive nature, I suppose, manufacturing and exporting sectors.
I think the time has come where India is going to take its rightful place in manufacturing. Its labor surplus and its availability of manufacturing capacity, power cost, resources, everything coming together, and the China Plus One playing a very important role here. Also, we have the government understanding the importance of manufacturing and trying to roll out production-linked incentives, which would give a fillip for manufacturing. So we're positive on manufacturing because it's a logical step in consuming labor from agriculture.
So, Satish, I want to pick up on what you said there, China Plus One. So, you know, with the Chinese economy opening up once again, do you see money which had gone to India perhaps going back and being invested in China? And, you know, where does that leave things? Because when you look at Indian equities, they are looking very rich. They're the most expensive benchmarks, actually, the Nifty and the Sensex in Asia.
I couldn't agree with you more. It is true that Indian equities are expensive, and probably we could see some money moving back to China. But there are a lot of other structural issues that are taking place in China, which means that probably the money flow may not be as much. And the second thing that we have also got to understand is India's weight in the MSCI is now close to 15% ahead of Taiwan, just about ahead of Taiwan. And we think that's a big positive, and money flow will rightfully come through the ETF or the GEM route as well. But the valuations cannot be ignored. The Indian valuations are rich, and the opportunity is also very big, which means that probably there could be a bit of time correction going around here.
So give us a sense of what you're anticipating. If valuations are rich, what will we see in 2023?
I think 2023 would see some clarity emerging because in 2022 we had the Russia-Ukraine war, gas prices going up, and as you are aware, India is a net importer of energy, and consequently it induced a bout of volatility. And we could see valuations drag down a little bit due to time correction. And that's our base case assumption. We do not anticipate something drastic taking place here. And we don't think 2023 is going to be a great year in terms of earnings per se, but we think that it is going to be more of stock-specific opportunities. And we have to take a bottom-up approach here.
Satish, when you take a look at RBI policy, it's now inflation. How do you play that best?
Yes, I think central banks all across the world are, walking a fine wire on growth versus inflation. Inflation is clearly heading down. One, due to the base effect, and second, that commodities have actually corrected. And that comes in with a lag. So corporate profitability will kind of start nudging up and inflation will come down. My guess is that we could see corporate spreads increasing because money is becoming tight in the markets. We may not see GSEC yields nudging up very much higher. Central banks may not actually raise rates very much higher, but they would keep a tight money stance to cool off inflation. So that would mean that borrowers would actually have to pay more, regardless of what happens to the central bank interest rates.
Well, this is it, and I think that you're dealing with this particular issue that others are dealing with too as well. And you know, you mentioned or referred to liquidity. What is the liquidity position like? Is the RBI doing enough to facilitate that money growth? And also, what about the central government? What about fiscal policy? How can it assist here?
I think 2022 would be the tightest fiscal policy because the government had to borrow money for food, for fertilizer subsidies and things of that sort. And as we go into 2023 and energy prices cool off, we could see that ease a little bit. So fiscal policy would be, fiscal deficits would be very well under control. As regards the central bank itself, I think it needs to kind of monitor growth and liquidity. It does do corrective actions, course-corrective actions ever so often. But I think it's maintaining a far tighter liquidity stance than it did before, as at the beginning of 2022, for instance.
Satish, thank you so much for your time. Satish Ramanathan, CIO of Equity at JM Financial Asset Management. It has been trading for about 4 minutes now. Let's do a check on where